Good morning, afternoon, and evening, ladies and gentlemen. I know we have quite the global audience today from various parts of the world. Thank you for taking the time out of your busy schedules to join our event today. We will be discussing taxation and investing for American expats, as well as IRAs. I'm Abiel, the financial administrator here at Dunhill Financial. Joining me today, we have Caitlin Minute from Bright Tax and Brian Dunhill, as well as Anya Berezow from Dunhill Financial. So just a bit of housekeeping and a brief rundown of the format for this webinar before we get started.
Audio problems.
We will be putting everyone on mute as soon as the presentation begins. Please feel free to ask any questions in the chat, and we will do our best to answer them for you as we go along. However, we will also have a Q&A section towards the end of your presentation for you to ask any questions you may have. Just before we start, a few disclaimers to go through. Dunhill Financial LLC is a registered investment advisor. Bright Tax is a registered public accountancy firm. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Now, with that out of the way, let's get straight to the topics at hand. The first being tax. So Caitlin, do all Americans living abroad have to file US taxes? Why is that?
Yeah. Yes, absolutely. So Americans living abroad, just like Americans who live in the US, have to file US tax returns. The filing requirements are actually exactly the same for those who live stateside. And that information on its face is often a surprise to people who live abroad. We work with clients day in and day out who have this shocking realization that they do in fact have to file a tax return. And the reason is because the US operates on a citizenship-based taxation system. This is a unique system that is not found in almost any other country in the entire globe. So that's why I think there's such a lack of information out there. People assume that they're required to file and report taxes to the country that they're living in and working in, which is the case. And Americans abroad also have the pleasure of filing in the US tax return as well. So that's an important requirement for people to keep in mind as they live abroad, before they move abroad. And their international circumstance does make the tax return itself a bit more complex, but it is a requirement.
And what about Americans living abroad? How can they avoid double taxation?
So when you find out that you have to file a tax return and you're living in a foreign country that's already taxing your income, of course that throws up a red flag, and people ask, well, isn't that double taxation? Does that mean I have to pay taxes both in the US and in the foreign country that I live in? And the answer is that the US tax return is designed in such a way that there are mechanisms we can utilize to eliminate double taxation. And there are a few different ways that double taxation can be eliminated, including something called the foreign earned income exclusion, the foreign tax credit, and sometimes the use of tax treaties between the US and foreign countries. Those mechanisms can all reduce your US tax bill for a number of different reasons, some being the fact that you have residency in a country outside of the US, some being because you are physically absent from the US. And the other would be that you have taxes paid in the foreign country that we can use to eliminate your US tax bill. So these are all mechanisms to reduce double taxation. There are specific instances in which double taxation does arise, where some of these mechanisms can't be applied in specific situations. But overall, that would be the general method of reducing double taxation.
I'm going to throw in there, Caitlin, that sometimes you even get some people that get benefits from living abroad. Certain countries like France, where you avoid some of the state income taxes in the US, we have a lot of retired clients that go over there and they pay less than they ever would in the US. So it's not all bad news when it comes to double taxation.
Yeah, that's a great point. And particularly in countries where the tax rate is higher than the US, you're always going to end up paying the higher of the two rates. But there are cases in which you can get a refund from your US tax return, believe it or not, even though you've not paid into the US system. Again, every situation would specifically address that. You know, if you're using the mechanisms appropriately to reduce your US tax bill, that will determine whether you're eligible for that sort of refundable credit. But it is a possibility, and we see it happen. So
That's a lot of those child credits, right?
The child tax credits, exactly, if you have a dependent child. So, you know, a lot of people are trying to keep their kids out of the tax system altogether, right? Because they want to avoid, so they say, well, do I even want to get a social security number for my child? But whether you get the social security number or not, your dependent child could have US taxation, whether you've gone through or could have US citizenship, whether or not you've actually gone through the process of getting the report of birth abroad, et cetera. So there's lots of logistics, but it definitely can be to your benefit to do so.
So if Americans get taxed on their citizenship, what happens if they're not aware, like you said, that they need to file taxes? What do they need to do?
Yeah, this is a super common situation. The last time I kind of looked at the numbers, only about 10% of Americans living outside of the US were actually tax compliant. So that leaves a huge percentage of Americans who have this gap in tax reporting, whether that be because just a lack of information, they didn't know that they had to file a US return. Kind of fear of the system and getting in the system in the first place is another common scenario. And there are people who don't even realize that they're US citizens or realize that they have to file a tax return for a number of different reasons. This is probably the most common scenario. When I got on the phone with a client for the first time in the matter of a client relationship, the first thing they usually say to me is, you know, I didn't know that I had to file, and I opened up the newspaper this morning and read this article about US taxation, or I went to the bank and they asked me to provide my social security number. And, you know, for those people, they're UK based bank, or they're wherever that may be in the world, and they're asking for a social security number. That's like, you know, the red flag goes up, the alarm bells start ringing, and you go down this spiral of anxiety where you just didn't realize that you haven't filed a tax return for the past 30 years during your time abroad. So in those circumstances, we recommend something called the Streamlined Procedure. And this is an IRS procedure that you can find if you just Google the IRS Streamlined Procedure. And it's basically a path forward for those who haven't filed a tax return and they have international circumstances. Usually it's foreign residency, foreign bank accounts that need to be reported, et cetera. And in using this streamlined procedure, you can become compliant in a penalty-free manner. I would say that's probably the most important and biggest benefit of the procedure. But also you're only filing the past 3 years of past due tax returns. So if you've been abroad since 1980, we're not filing every single tax return that you've ever missed. We're just filing the most recent 3 past due years. So that would, in most circumstances, be the appropriate path forward to get compliant, to get back into the system, to avoid penalties. And why it's important to do so is that we're going to find that those people who are getting the request for a social security number from their bank, that's going to lead to reporting back to the IRS and information sharing between the IRS and foreign governments. And so the world has become this transparent place of information sharing between banks and tax systems. And so it'll be harder and harder to kind of fall under the radar and keep out of the eyes of the IRS.
Okay, but it sounds like there is a solution for people who who just kind of ended up realizing they need to file taxes elsewhere.
Mm-hmm.
So that is reassuring. But what about if they have investments abroad? Do they have any additional reporting requirements?
Yes, is the short answer. When you have financial investments outside of the U.S., that could be an investment in a foreign company. That could be an investment in a foreign partnership. It could be investment in mutual funds that are operated outside of the U.S. That's where things start to get quite complex. At a starting point, when you have $10,000 or more in financial accounts outside of the U.S., you're going to have to file something called an FBAR disclosure on an annual basis. And the FBAR is not a tax driving form, but it is a method of showing the IRS where you have accounts abroad, and you're showing them your balances, where the money is held, the account number, et cetera. It's a disclosure only. So that would be kind of the starting point disclosure wise for financial accounts or investments in this case. In addition to that sort of disclosure, you're also looking at potential foreign corporate disclosures, foreign partnership disclosures, which are very complex informational returns to show the IRS basically what's happening outside of their view. Because the comparison I like to make is that if you were owning and operating investments through a US-based financial firm or a US-based account, they're going to have direct access to look at that and see what's happening. But because your accounts, your investments are located abroad, the IRS doesn't have that ability to look and see what's happening, what income is perhaps not being reported, what capital gains need to be reported, et cetera. So they're using these disclosures as a means of ensuring that US taxpayers are appropriately reporting their income. One of the, I suppose, most despised reporting requirements from an investment perspective is something called the Form 8621. And the Form 8621 relates to what's called the passive foreign investment company. And really the most simple way to look at that is it's a foreign mutual fund. So any sort of foreign pooled investment that's not traded on a US market and regulated by the US markets is going to be subject to this PFIC requirement. And without boring everyone with technical details, the PFIC is essentially a means that the IRS has to tax foreign funds, foreign pooled investments at the highest tax rate. It gets nasty when you get into the details, and the best advice we usually give, always, of course, from a tax perspective, is to avoid those investments in the first place, because your tax reporting burden just becomes so heavy that it's not worth, getting tangled up in that web. So that's one to be aware of. We see it quite frequently, because certainly if you're living abroad, it makes sense to invest in mutual funds. That's a common investment vehicle, of course, but it does lead to very, very restrictive tax reporting requirements.
Thanks, Kaylin. I think that actually perfectly segues us into investing as a US expat. And speaking of PFICs, Brian, how would you say that an American abroad can invest while avoiding onerous taxations like PFICs? As Caitlin said, avoiding investing in them is one option, but how can you get around the limitations of not investing in PFICs?
Well, I think Caitlin summarized the first thing that's really important to remember of what not to do, which is four-letter acronyms are bad things, bad words in four-letter instruments. So as long as we avoid PFICs, we're going to be very happy. Even if people are talking about these QEF elections or this or that or the other, it's not as attractive as just investing back in the United States. Now, that's because essentially that avoids all of those PFIC restrictions. If we buy US securities, if we even buy individual equities on European markets or international markets, we're avoiding all these erroneous rules that go along with PFICs. Now, our firm, we build all the investments in the US, i.e. we're buying them in US securities. That doesn't mean that we have an open gambit to buy whatever we want. For instance, if you're in the UK and you buy US mutual funds, they will not be HMRC compliant. So Caitlin will be able to do a wonderful job on your US taxes, but instead of being taxed at a 20% rate here in the UK, you will be taxed at your full earned income rate. And that can go close to 50%. If you go throughout Europe, if you buy those mutual funds, well, you're not going to be what's considered MiFID compliant. There's no real problems with not being MiFID compliant at this point in time, but my guess is one day, essentially the Europeans could start to fine people for not being MiFID compliant, just like the US fines people for not following the PFIC rules that came out, 50 years ago under Nixon. So we want to simply buy individual securities, individual bonds, and in many countries, we can even buy exchange traded funds. In the UK, we have a limited list, but that gives us those two elements, and it gives us the ability to build a diversified portfolio for somebody with just about any size portfolio. So it doesn't matter if you're an emerging affluent or if you're a high net worth individual, all of a sudden, every American abroad can build a portfolio in the United States with their European address or such. Why do most of the banks actually close down their accounts? Well, simply put, they don't have a license on both sides. We have a license in Europe, a license in the UK, and a license in the US. So therefore, we're able to place clients on both sides. Now, the key consideration that you really want to think about when you build your portfolio is that if you toss it into, let's say, Betterment, Wells Fargo, UBS, doesn't matter what institution in the US you go to, all of those institutions are going to be looking at building you a portfolio that's mostly US dollar centric. Now, that's because 99% of their clients are Americans that are going to retire in America. And therefore, by having more US equities in their portfolio, they're actually lowering that currency risk, which is great for their clients. But you and I, we are not Americans that are going to retire in America. Maybe you are, and then you can use that portfolio. But if you're like me and you're probably going to stay here in Europe or the UK, you want to do the opposite. You want to build a portfolio that's more pound-centric if you're going to retire here in the UK, Euro-centric, Europe, or in some other instances, like we have some clients down in Australia where we'll build something that's Australian dollar-centric. So that is the natural hedging of that portfolio. So we want it to be compliant in the US. We want to make sure we don't double up on the taxes across the board. We want to make sure we're in compliance with European or any other country's rules. And then essentially we want to limit that currency risk so that it looks like your friends' portfolios.
Thanks, Brian. I don't know if Anya or Caitlin, you want to add anything onto that in terms of maybe how, would there be any differences in the taxation on that? Or Anya, would there be any differences in building a portfolio from your perspective?
I think Brian has covered it quite well.
And I guess from the taxation perspective, to keep things extra simple, it's always going to be easiest to do things stateside. But as Brian pointed out, for those who have the intention of spending their retirement abroad, that's always, not always practical for currency reasons. And kind of the PFIC in itself arises when you're investing abroad. So there's kind of this conflict of interest, right? Where your life and your livelihood is abroad. But from a tax perspective, keeping things simple would mean holding everything stateside.
Now, I'll actually add on to that, if you don't mind, Caitlin, because that's a perfect summation there. We like keeping things stateside. We do have providers that actually allow us to hold all those US securities over here, and it will keep Caitlin happy because they still deliver a 1099 to make the tax filing as easy as possible. Now, the reason that we don't recommend them every single time to every single prospective client is because they cost a little bit more when it comes to trading and platform fees. So just like anything in Europe, you pay a little bit more in Europe than you would in the States. Yet if we own the exact same investments in the States, sometimes it's going to be a little bit better. But if you prefer getting your statements in euros, delivering in euros, having it delivered out in euros, or you just want to keep your money out of America, yeah, we can accomplish that. The fee schedule is just a little bit different.
And I mean, as far as fees go, how much more are we talking? Because when it comes down to it, if you're going to be paying your tax accountant to prepare the PFIC form and then paying the highest marginal tax rate on the investment anyway, I'm sure that's saving you at the end of the day.
Oh, absolutely. It's 0.35% more to use our European provider. And then they just charge on a proportion of the trades. So I think it's about £8 per trade, but the number of clients that trade that day, they divide it up by that. So if we have 10 clients that trade that day, it's only 80 cents per trade. So it's marginal compared to what we'd pay in the States, but the savings are still much greater than actually going into any of the different PFICs.
Mm-hmm.
Thanks, Brian. Thanks, Caitlin. So what about IRAs? How do those work? And why should an investor consider contributing to an IRA or a Roth IRA?
Well, Avi, that's a really good question. And really, there are two big reasons why one should consider investing in an IRA or a Roth IRA. First, of course, it's to give your money a chance to grow. Of course, the earlier that you start contributing, the more opportunity you'll have to build wealth. And eligible taxpayers can contribute $6,000 per year to a traditional or a Roth, $7,000 if you're over 50. For both tax years 2020 and 2021, the limits are the same. So at the first glance, it might seem like the contribution limit is not that much, but it certainly adds up over time. So it allows you to build wealth over time. And of course, the second reason to invest in an IRA or Roth is for the potential tax benefits. So the main difference between the two is that traditional IRAs, in general terms, in those accounts, your earnings grow tax deferred and distributions are taxable. As far as your contributions into the traditional IRA, they can be tax deductible potentially, but if you're a US expat, that is rather unlikely. For a Roth IRA, that's quite the opposite of a traditional IRA. Your earnings still grow tax-free, but qualified distributions are also tax-free. Contributions are always after tax, and so you still have to meet contribution eligibility for a Roth IRA. Now, the nice feature of Roths is that even if you don't meet all the qualifications, there's always an option for a backdoor Roth IRA to consider. But I won't get into that for now.
Thanks, Anya. And in terms of these IRA contributions, how does an investor know which one to choose and who should actually make these contributions?
Mm-hmm. Again, excellent question. And the answer is that it really depends. Again, in the most general terms, if you're young, you're likely in the lower tax bracket now compared to the future. Roth IRA might be a good idea, assuming that you qualify. If you're in your 50s, for example, you're more likely to be in the high tax bracket already at the peak of your career. And if your tax bracket is not likely to change in retirement, you're probably going to go with a traditional IRA. However, there are many other considerations that US expats should keep in mind. Generally, you certainly must have earned income that is over and above the foreign earned income exclusion and or the foreign housing exclusion that Caitlin has referenced earlier. It's also really crucial to consider the country, the tax rules of the country where you live now and where you plan to retire and take distributions. So it's really country specific. Generally, IRA contributions, if allowed, they make a lot of sense in the country with low tax rates or no tax. United Arab Emirates or Singapore, for example. But maybe you're not likely to make an IRA contribution if you live in a high tax a country like Germany, for example. This is because the traditional IRA would just serve as a possible deduction for your taxable income and would therefore reduce your tax liability a little bit. So even if a traditional IRA is not permitted or does not make financial sense, you always have an option potentially for a Roth contribution. And for more information on IRA contributions, Roth conversions, backdoor Roths, retirement plans, and foreign pensions, I definitely would love to invite you to a seminar that we are hosting tomorrow, just on those specific topics.
Thanks, Anya. The final question regarding IRAs is, can an investor access their IRA everywhere in the world? You spoke about differences between, contributing to your IRA internationally, but can anybody make disbursements, and what are the consequences of those?
Yeah, great question as well. I mean, it really, you certainly are allowed to take distributions. The question is whether it's going to make sense for you, right? It depends on country-specific rules and double taxation agreements that the US has with each specific country. Of course, it also depends on your age. Are you past that 59 and a half age when you're allowed to take out of your retirement accounts? Even if you aren't, of course, there are rules around that as well. So there are certainly many different considerations, but most definitely, in a lot of cases, you can find ways to take money out. And of course, at Dunhill Financial, we would encourage you to save and grow those accounts as much as possible. But there's certainly a lot of good strategies to withdraw the assets when you're abroad.
Thanks, Anya. I don't know if Brian or Caitlin, you'd like to also kind of jump in the fray before we move into the Q&A, if anything you feel you'd like to add regarding IRAs or investing or taxing.
I think the only thing that I'd like to add on the whole specific topic of IRAs is sometimes it does feel really complex. Sometimes people get overly obsessed about the tax. Sorry, Caitlin. And they forget the reason why they're investing. So all of a sudden, if you don't know where you're going to retire, so i.e. you don't know what you're going to be taxed at the end, you don't know if you're going to get that contribution at the beginning, all of a sudden, if that seems too perplexing, sometimes the answer is just get your investments going in a taxable account. I.e. one of my favorite expressions is, let's create a tax problem and then we'll figure out how to optimize it and reduce it later. Instead of having analysis paralysis and just not doing anything and not getting invested in the first place.
I run into that scenario a lot where, people are just like doing everything they can to avoid the tax. But at the end of the day, you have tax because you're generating income. So yes, there is, of course, the goal to make the most tax efficient structure possible to mitigate tax as much as possible. But if you're in a situation where you're generating income, at the end of the day, there's a net gain there. So of course, the strategy is key in finding ways to reduce the tax liability or what we specialize in. But like you said, that if the goal is generating the income in the first place, then that's probably where you should keep your focus.
So thanks very much, everyone, for this very informative presentation. I hope our audience found some useful insights in there. So we will now open up to Q&As. So please feel free to post your questions in chat. I see we've already got quite a few questions, which we'll start going through. But please note that we won't be able to answer any sensitive questions. But please feel free to email either Dunhill or BrightTax. And the contact information will be available on the follow-up email to this presentation. But without further ado, let's get right into the Q&A. So the first question we have is from Pamela Strawgate, which is, what is the amount over which we have to pay tax in the US if we are a fiscal resident in another country, in her case, France?
I get this very specific question very frequently. And I think what drives this question in the first place is the understanding of the foreign earned income exclusion, which is $108,000 of income that can be taken as tax-free income, given the fact that you reside abroad and have a physical presence outside of the US. But beyond that specific mechanism of reducing US tax, there are other ways to reduce your US tax bill. For somebody in France, your tax rate is almost certainly going to be higher than the US tax rate. And as a result, we would be using the foreign tax credit to reduce your US tax bill. So for somebody in France who's earning $500,000, even though you've exceeded that $108,000 threshold that's associated with the foreign earned income exclusion, you can still use the tax that you've paid in France to offset your US tax bill. So it's very possible that if you're a wage earner at that income level, you still may not owe tax to the US. So it's not quite as cut and dry as that $108,000 threshold. Or not being exceeded in terms of having to pay U.S. tax. And that's a good rule of thumb for any country that has a higher tax rate than the U.S. If the tax rate abroad is lower than the U.S. tax rate, based on your bracket of income, of course, you are likely to begin incurring a U.S. tax liability after that $108,000 threshold. And the assumption there is that you've met the requirements of the foreign earned income exclusion to utilize that $108,000 tax break. But again, there are different mechanisms that can be used, including, the IRA contribution, et cetera, that can be useful in reducing your US tax bill. So it's always very situation specific, and it's also important to ensure that you're using the correct mechanism, the mechanism that works best for you to not only reduce this year's tax bill, but your future tax bills.
I'd like to add something in there, which is going to annoy all the workers in France, but is important for the other side, the retirees that are in France that work their entire time in the US, have all their investments in the US, and now they have moved over to France and are just living in France. We don't have hardly any clients that are workers in France that pay any tax in the US, and we hardly have any retirees in France that pay any actual tax in France. They pay it all in the US. So it is one of the most interesting double taxation agreements that you can utilize to offset those different sides and actually pay a lower tax than a Frenchman would in your retirement. So for all of us as we plan our retirement, France is a great place to move to. Just don't die there. It's very expensive to die in.
So the next question is from Bill Spingarn, and it's regarding tax liability. If an American abroad is issued stock as part of their compensation and they pay taxes for that equity as part of normal income in their resident country, are they subject to further taxation beyond that in the US? Does the IRS just consider this ordinary income?
Good question, Bill. And it sounds like what's happening here is that they have a stock-based compensation package, and it's going to be treated in the same way a stock-based compensation package would be treated in the US, which can vary based on the nature of the equity, the options. But generally speaking, certainly you're going to report the income. There's no doubt about that. That's always going to happen. But then if you're paying tax on your equity compensation abroad, you're probably going to be able to get a credit on the US return for that. So the treatment of the options or the equity award in this case will be the same treatment that the US system would treat it if you were earning in the States, which might be ordinary wage income. And if that's the case, you could potentially even exclude it using that foreign earned income exclusion. So it's something we do see.
The next question we have is from William. So for those who receive a foreign pension, in his case from France, where do they declare that on the new Form 1040 for 2020 income? Should the dollar equivalent go on the new line 5A for pensions and annuities?
Yeah, that's where I would put it. The 1040 is changing every year, and I certainly don't claim to have all of the line numbers memorized as it is changing each year, but we would put it in the same place that a US-based pension would go. So the same place your 1099-R income would show up.
Another question from Bill. How are single equities such as stock on foreign exchanges taxed?
So directly held shares would be taxed in the same way that a share held in the US market would be taxed. So if you're realizing a long-term or short-term capital gain, it's going to be taxed in the same way. And dividends will be taxed in the same way. Whether they're qualified dividends or not will actually depend on the tax treaties with the country that share is associated with. But there wouldn't be a significant difference in treatment related to the taxation of directly held shares like there would with those PFICs that we were talking about. So that is an option for people who are wanting to trade abroad, is to directly invest in equities. But certainly, well, unless you're pretty talented in investments, and maybe Brian can comment a little bit further on that. But it perhaps is a little bit more risky than some of the other investment strategies.
To me, it's all based on size. If you have a multi-million-dollar portfolio, we can build a portfolio with individual equities, individual bonds, and you can do the same. Now, all of a sudden, if you're looking at different sizes, if you have an IRA that has 100,000 or 200,000, and you're trying to do it with individual equities, you start getting individual equity risk. You don't get out into other marketplaces. And this is extremely true if you're getting closer to retirement, where you're needing some fixed income or some fixed income equivalents, i.e. you don't want to be just fully invested in the stock market. All of a sudden, if you call up and you want to buy $10,000 of a bond, most of the banks are either going to charge you such a high price, or essentially they're just going to turn you away. So I find it better to use some of the pooled instruments like ETFs based on those types of sizes, and be able to get into the markets in the same diversified way that you would if you were not an American expat. Why reinvent the wheel?
So we've got a couple of questions from Paul. The first one is, how can an expat use up excess foreign tax credits? Is it necessary to have earned income from a lower tax domicile?
So what the person is referring to here is the fact that when you live in a jurisdiction where the tax rate is higher, you can use up that accumulated tax, or the tax paid. Let's use France again as an example. You use the French tax paid to reduce your US tax bill. And then at the end of that exercise, you have these excess credits because the French tax bill is actually higher. So you have these excess credits that can be applied forward for up to 10 years. They're called foreign tax credit carryovers. And after 10 years, you could have a significant amount of this kind of credit hanging out and eligible to be used somehow. The most common scenario to utilize those credits would be generating some sort of tax-free event. So, for example, in the UK, you can be accumulating these general category credits as a result of wage earnings over the years. But then at the end of your career, you have this option to take a 25% lump sum distribution from your UK pension, if I understand that correctly, as a non-UK tax expert. But that would be a tax-free event in the UK that would actually be taxed on the US return. So that would be an opportunity to take tax-free income in the UK, but then use those credits to offset the US bill that would otherwise be generated. So that's one opportunity. Another would be to, like the person here asked, move to a lower tax jurisdiction. So move to a country where the tax rate is lower than the US rate, and begin generating income over the $108,000 threshold, in which you can then apply the credits that you have in excess to reduce your US tax bill.
The only thing that I'll insert in there, in the UK, they have this weird provision that you can take out 25% upfront tax-free, and then it goes into your regular tax bracket. So you could potentially get it tax-free, but it might not all be in one lump sum.
Right.
It gets complicated, and you need to actually look at the specifics of that person.
The next question from Paul is, if a tax authority does not distinguish between short-term and long-term capital gains, then presumably short-term gains taxed locally at a lower marginal rate than US would still be taxed as regular income in the US. Therefore, the taxpayer would wind up paying the spread between the local short-term rate and his marginal income tax rate. He was wondering if this is the case?
And perhaps I don't understand the question entirely, but the IRS is always, so if your local tax system doesn't distinguish between short-term and long-term capital gains, the IRS still would in the application of the US tax rates. So if you're exceeding a 1-year period in holding for that equity, the IRS is still going to give you the qualified rate, which is going to be anywhere between 0 and 20% tax. But if locally they're still taxing it at ordinary tax rates, you perhaps would end up paying the higher rate wherever you reside, because that rate presumably is higher than that 15 or 20% US tax bracket. So it's that specific example. You can take the tax credits and perhaps you would generate excess credits to carry forward and apply against future passive income earnings.
So Mark asks, as a US citizen living in Canada, am I eligible to invest in a Roth?
Yep. Nothing about the fact that you live abroad prevents you from utilizing the Roth IRA as a mechanism for retirement savings. So yeah.
A question from John. Would foreign annuities, SPIAs, also be subject to PFIC-related taxes?
The answer to that question will depend on the specific details of that foreign, what kind of plan was it that they were referring to? Well, I guess to keep it general, you would have to look at kind of the details of that plan to see if it's a qualified plan for US tax purposes, and then you would determine whether the PFIC would be relevant or not.
So essentially what's inside of the actual insurance vehicle is sometimes more important than the fact that it's an insurance vehicle. Whereas in Europe, they'll typically say it's an insurance vehicle and it ends up looking like a variable annuity in the United States. So therefore, it should meet those same provisions and I can own whatever I want inside of it. But the IRS still hasn't given a true determination on that. So you have a lot of differing views, and all of a sudden, to me, you find an accountant that kind of errs on the side of how aggressive or conservative you want to be. Now, I find that I can get a lower cost plan in the United States, and that's why I do it that way with our clients. And I'd rather be conservative when it comes to investments, because I think an audit had is actually an audit lost, even if you were right in that whole concept. Other people are going to want to be more aggressive, and that's where you can find those differing views on those IRS filings because they haven't made a determination.
Yeah, that's definitely one of the most challenging things about what we do as tax accountants working in kind of the international arena of taxation is the fact that there is almost no information that the IRS provides to us regarding all of these gray areas. I think the only concrete example I can give is that the IRS does recognize the RRSP in Canada, but beyond that, the IRS will not go out on a limb and say, okay, well, the SIP in the UK or whatever plan it is, wherever you might be, the IRS is not going to include.
Canada and the UK are good. It's the rest of the world.
Yeah, and well, the UK is by means of the tax treaty, but they won't specifically speak to a certain type of plan. But you're right, the treaty gives us pretty good coverage in the UK, but the rest of the world is just kind of a circus.
So the next question is from Kate, asking, where can she invest from abroad? Can she invest in the US using her family's address?
Well, we recommend not using your family's address in most situations for several reasons. First of all, you end up being in a situation where you're actually lying on a document. Second of all, if you're living in certain states, there's only 7 states in the United States that you don't have a state income tax. California and New York are really notorious for actually dinging somebody that uses a US address in New York and saying you owe state income tax because look, this proves that you have investments at that address. If you're going to use a US address, well, I definitely pick one of those 7 states that doesn't have a state income tax, to remove yourself from that situation where they have it. We've heard some stories where different firms have basically pinged the fact that they're calling in from abroad or this or that or the other. Not that many issues, but I would find one of the investment firms that actually can service you and wants to service you from both sides, because then they're going to be able to give you the advice that you need, which is setting up the investments in the correct way, making sure that they conform with both European, UK, or whatever country you're in's rules, as well as American rules, and getting you those documents that Caitlin would need to provide your taxes. So you can, but I wouldn't recommend it.
Yeah, we've seen a lot of clients come to us where their US financial institution is just frozen the assets because they found out they were abroad. And it doesn't always have to be associated with the address. Sometimes they can see where you're logging into your account. And so it's kind of in the digital age where they have access to all this information, it can be pretty easy to detect people who are living abroad.
What about investing with under 10K? Is there a possibility for that?
Yeah, we have a new program, and we'll be rolling out some better technology over the summer. But we have a program where we will let anybody start from any value. So as long as you're setting up a monthly accumulation plan, we can set that up on the state side. If you're wanting to use our European provider, they do have a minimum of 20,000 euros, but we can still do the same thing with the same exact shares in the United States with no starting value point. So no problem on size. Key thing is get started. Save early, save often.
Elizabeth is asking, do you have some guidelines for how to determine the max annual amount to withdraw from an IRA after turning 60? Are there considerations other than just looking at the tax brackets?
From a financial planning standpoint, it's a really good question, right? Because you don't want to live your life just only by taxes, right? You want to look at, okay, what is my estimated life expectancy? How much do I need to live on every year? And then make a determination, okay, well, let's go back to my accounts. What do I have? What taxable investments I have? Any Roth or traditional IRAs? And then design a strategy that's best in terms of distributions. And if you have all those different three pieces, Roth, traditional, taxable investments, then you're in a really good spot, even if you move during retirement or after 60, to really optimize your tax situation. But again, it's not all about taxation. We also want to take financial planning into consideration and make sure that that money lasts throughout the rest of your life. Make sure you're comfortable with that.
So Mark asks, I'm a US citizen living in Canada. How far back can you file a past tax return if you have young children in order to get the child tax credit? I've already filed back to 2016 and don't think I can go back before that. Is he right?
That's right. He's right. Yeah, you can't go back any further. The statute of limitations for requesting a refund from the IRS is 3 years from the due date of the tax return. So that 2016 tax return, which would have been due as you live in Canada on June 15th, 2017, would have expired in June 2020 in terms of the statute of limitations for the refund. So the IRS, you couldn't go back further than that to request those child tax credits. And if you have to file for other reasons besides the child tax credits, the IRS will simply disallow the credits and not pay out the refund.
So you have to have a new round of kids.
Yeah.
Scott asks, they're planning to retire back in the US and they'll use proceeds from their UK home to build a house in the US. Is there any optimal way to go about this?
Well, there's some tax things that you should really think about if you're going to be selling one home that's a foreign home to buy a home in the United States, which is the effect that the IRS is only going to consider it in foreign currency, in US dollars. So this hasn't been a big deal for most of us when the dollar was going up, that all of a sudden We had 12 years of the US dollar increasing, and therefore it was hard to make a gain on real estate in dollar terms over the course of time. But now, as we've had since August, the dollar going down to many relative currencies, we need to be cognizant of when we'd be selling and what you might have as phantom gains on your US taxes, which Caitlin would be able to dig deeper into, which to me means before you go sell the house, do your contract, and then contact Caitlin to just file, do some preparation on the tax ramifications well in advance to make sure that you're not going to get a tax bill that's larger than the gains that you had on the house. If you want a good example, go to our Prime Minister here in the UK, Boris Johnson, American citizen, sold a house, got a US tax bill, got really mad, gave up his US passport after paying a big bill and making a big mess of things. So
yeah, the foreign exchange gain or loss in some cases is always a surprise to people who are just used to operating in the foreign currency. We calculate and convert everything to US dollars. So if you buy an investment in 2006 and sell in 2016, you have to consider that the FX rates will apply based on the transaction dates, not everything just at the tail end of the transaction. So that's a speed bump we see as well.
I stole your whole tax thing, and then I forgot to actually mention the financial planning, the financial planning aspect. Sometimes when you're going to make a big purchase in a foreign currency, you will want to talk to a planner about potentially buying a forward contract on the currency. Some of the currency providers charge as little as 5% down, and you can go ahead and hedge the entire amount in a foreign currency, which really works if you have, say, all your cash in US dollars. You're wanting to buy a new chateau down in France, and you feel that the dollar is going to go down, so you're depleting some of that value. You purchase for 5% of what you're going to be needing to move over a forward contract, and you're locked into that rate for that next year or two in the future. So definitely some planning that can be made depending on where the currencies might be moving.
So Marcia asks, could you please elaborate if ETFs or funds must have a CUSIP for a US investor based in the UK?
So the CUSIP instrument, you're going to want that for Caitlin's side on the US side of things. That's what avoids being a PFIC. So you could buy the S&P 500 on the London Stock Exchange. That's still going to be a PFIC because it is still a foreign instrument. So essentially, yes, you need a CUSIP. If you're here in the UK, you also want to make sure it's HMRC qualified so that you get the reduced rate here in the UK. That means you have to go to Her Majesty's the Queen's Revenue Service and make sure that it fits on that list. I think now Cam, our analyst, he'll correct me if I'm wrong on this. I think there's about 90 US ETFs on that list. We can build a nice portfolio with that group without having any problems.
Andy asks, beside mutual funds being a no, what about other investment options such as SIPs and ISAs?
Wonderful question. So as Caitlin and I were talking about earlier, the US and the UK have a wonderful double taxation agreement, one of the better ones in the world. I don't know if you can classify things as wonderful in the double taxation arena. It's one of the better ones. So using a SIP, even if you move back to the States, you're fine. We have a product that if you move back to the States and you don't want a pound-centric pension, you can move it into our portfolios that's US dollar-centric and using those same US ETFs. So absolutely no problem there. And then you're just able to trigger it based on how you want to pay the tax later and how you want to do your financial plan, which is a perfect arena to talk to Anya about. Now, when it comes to ISAs, that's a little bit different. Individual savings accounts, the FCA, which are the regulators here in the UK, will not allow any non-UK investments inside of a ISA. So we have ISAs that are all individual stock, but that's not a perfect investment for an emerging affluent client. So it works if you've got $1 million portfolio. We've got all these ETFs outside of the ISAs, and we're just building a group of diversified stocks in a lower tax regime, i.e. we get it tax-free in the UK. We just have to pay the 1099 tax due in the United States. Not perfect for your 20-year-old, 30-year-old that's just starting to get going and putting money away. So it's a little bit different vantage point on how we go about investing for an American expat here in the UK versus a non-American expat.
Yeah, and I guess the ISA, I mean, from what the little I know is that the ISA, the benefit of the vehicle is that it's tax-free on the UK side. So, you know, the fact that the IRS doesn't recognize that treatment, I think perhaps makes it much less attractive in the first place.
Well, we'd be taxed 20% here in the UK. So all of a sudden, if you're in a lower tax bracket, if you can get 5 or 15% in the US, it's still worth it, but not as worth it for a non-American.
Right.
Find yourself a non-American spouse, provide for his or her ISA, and then, you know, call it a day.
So we've got time for one last question. Anything that isn't answered here today, please feel free to respond to the campaign email that will come out in the next few days after this event. But as a final question from Bill, what are Dunhill's costs or fees if we use them for our portfolio? Also, what institution holds the investments on our behalf?
Wonderful question. It's almost like it's a plug question. So thank you, Bill. We have a couple different service levels. Now, essentially what we're trying to make sure of is that every American citizen, no matter where they are or how much they have in their back pocket, can get started and get investing. So the easy way to look at it is that we have asset management and then we have financial planning. The asset management is really simple. You can start at any dollar amount as long as you're doing a recurring investment each month. We'll let you even start with a $0 account, and we don't charge any entry fees or any fees to take the money out. We just charge 0.5% on the value of the account per year to get it invested. It's charged on a quarterly basis, so instead of 0.5%, it comes out to 0.125% per quarter. Just to put that in perspective, that means a $10,000 account ends up being charged $12.50 per quarter. Now that's the asset management side. That means all we're taking care of are the investments. You're sending in money, we're getting it invested. You ask us to send you money back, we send it back to you. The other side is financial planning. And that's where Anya is the head of our financial planning practice, and she will help you build the full financial plan of how much you should be saving, what type of structures you should be saving in, other goals along the way other than retirement, i.e. children's education, 529s and such. I bet Caitlin could spend an entire hour just talking about those, of why they're sometimes good and sometimes they can be a devil in disguise, and everything that life brings in between. And those charges, they depend on the size of the client, etc. That's all can be found directly on our website under the ADV filings. But one of the things that I can say is that they are about the same as what you would pay for any US provider, if not lower. So we can send those to you based on your exact parameters, but basically nobody on this call has an excuse for not getting started because we have a solution for each and every one of you.
Thanks, everyone. And that will conclude the presentation for today. In the next few days, a follow-up email will be sent with a recording of this event, as well as the contact details for Brian, Caitlin, and Anya. If you have any questions that weren't answered here today, please feel free to shoot any of them an email and they'll get back to you as soon as possible. With that, I wish everybody a pleasant morning, afternoon, or evening, wherever you're in the world, and we hope to see you next time. Thank you.